Guys, welcome to SafeFab.tv and thank you very much for joining us. So in this video, we want to talk about what's coming next, especially with the US Fed now reportedly going to be loosening its purse and stop selling assets. And at some point, we expect them to start printing more money to buy assets onto their balance sheet. That's what we want to cover today, guys. Central bank liquidity. But before I proceed with this video, please note that I am not a financial advisor. You do require financial advice. Please approach someone who's actually trained to give you financial advice. The information contained in this video is just for educational as well as entertainment purposes, and it's also not meant to be for UK audiences for the sole reason that the UK authorities do deem anything crypto related to be extremely risky, and they are trying to play hard, trying to prevent you from accessing the market, I suppose. But that's up to you, make your own decisions, guys. I'm not here to convince you to go in either direction. That said, let's come back to this video then, where we are looking at central bank liquidity, which I think definitely matters for the crypto markets, but it's not just going to be a simple Fed print, which then leads to number go up. That's not the story anymore. In this video, I'm going to try and walk you through how global liquidity affects crypto, what's actually happening with the Fed and other central banks, and how that ties into the recent crypto drawdown. And we also need to look at the scenario of a supercharged bull run, nothing bigger or something in between. That's what we want to cover in this video. So let's jump in then. Why liquidity from central banks matters for the crypto markets? Well, adding liquidity usually means some combination of the following. You got rate cuts, which is where they are lowered as a policy, which then leads to cheaper leverage and triggers higher risk appetite. And when they are stopping quantitative tightening, it means they are no longer shrinking their balance sheets. This means they are no longer selling whatever assets they hold on their balance sheet. And when they are doing or commencing quantitative easing, it means they are buying their own bonds, expanding central bank balance sheets, and boosting reserves. That's what they'll be doing. There are several studies and analyses that have been carried out that now treat Bitcoin and crypto as high beta liquidity trades. What does that mean? Well, research on global M2 and central bank balance sheets find Bitcoin is strongly sensitive to changes in global liquidity, with price reacting most to the rate of change, which is accelerating versus decelerating liquidity rather than the absolute level. S&P Global's work on crypto and macro shows an inverse relationship between interest rates and crypto prices. Higher rates generally hurt risk assets like crypto, and it's consistent with classic asset pricing theory. Education pieces on quantitative easing and quantitative tightening and crypto show a clear pattern. Quantitative easing during 2020 to 2021 coincided with a massive Bitcoin and altcoin bull market, while quantitative tightening plus aggressive interest rate hikes from 2022 onwards produced a brutal bear market. So when global central banks are loosening, crypto is historically loved. When they are tightening, party tends to end. So far, if you're one of those who is still blating on about the 4-year cycle, you need to pause and just think about what we just covered so far. But there is more yet to come. So what's happening now? We are in late 2025, which is the last quarter of 2025. Well, let's look at the recent context. The Federal Reserve has already delivered at least some of the cuts. I think it's been one or so cuts in the region of 25 basis points. I think that was in October, but kept a hawkish tone, then followed with signals of further easing, which Jerome Powell, about a month ago or even less, he tried to water that down and he tried to maintain that they may not be cutting in December. Meanwhile, JP Morgan now expects another 25 basis points cut in December, with market pricing an 85% chance of that move. The Fed's dot plot shows 2 more cuts this year and a gradual path of lower rates into 2026 and 2027. We don't yet have an official quantitative easing restart, but even rate cuts and a pause in quantitative tightening market turn from maximum tightness towards easing. Markets will start trading that pivot well before any formal quantitative easing announced. Markets, they are forward-looking. They don't wait for things to happen for them to actually do something. That is independent of the actual impact on the markets or in the financial world, where any cuts might actually deliver results maybe 6 months or so afterwards. But markets are forward-looking. They don't follow that. They bet on things improving in the future. They don't wait for things to improve for them to react. And looking at the global picture, global liquidity indices, you're talking of global M2 supply aggregate central bank balance sheets, are increasingly used as leading indicators for Bitcoin. Research find a positive correlation with a lag of a couple of months. European Central Bank research on its own quantitative easing shows that low rates environment can push investors into riskier assets, but Bitcoin did not behave as a safe haven during COVID quantitative easing. It still sold off hard in the panic, then exploded higher once risk appetite returned. So central banks worldwide don't move in perfect sync, but the global direction of liquidity is what matters most for crypto, not just the Fed by itself. We know China has been printing money for several months now, and the US will be doing it, and we know the European Central Bank has been making moves in that direction as well. So where are crypto markets right now? Well, based on recent data and information information we have so far from the markets, Bitcoin has dropped just over 35% from its October all-time high of 126,000 or somewhere thereabouts to the low of around $80,000, erasing most of its 2025 gains. I think now is, at the time of recording, is trading just above the 90K mark. This sell-off wiped approximately $1 trillion in total crypto market value and caused around $20 billion in liquidation during the October flash crash. Some analysts note that this downturn is institutional heavy. A lot of pressure came from ETF outflows and larger holders de-risking, which makes recoveries more sensitive to macro than in earlier retail-driven crashes. So yes, we are in a sharp drawdown after a massive run-up in an environment where macro uncertainty has been high, liquidity has been tightening, but it is now starting to turn. Institutional flows, you're talking of ETFs, funds, and corporates, are much more important than in past cycles. So how is extra liquidity going to actually transmit into results for the crypto markets? That's up next. Well, when the Fed and other central banks move from quantitative tightening to easing, crypto can benefit via several channels. The first one is discount rate and valuation channel. Here we are talking of lower rates, which lead to lower discount rate on future cash flows and option value of new technology. Risk assets with long duration narratives such as AI and yes, crypto get re-rated upwards. So there is a revaluation of all these technologies, including our favorite bags in altcoin. There's me hoping. Risk appetite and leverage also returns, cheaper funding and more reserves. Banks, hedge funds, and traders can take more risk. Crypto is a high beta risk asset, tends to move more than equities when risk appetite returns. But of late, we've been seeing assets such as Nvidia stock, as an example, shooting up like a meme coin. Same with Michael Saylor's strategy, shooting up like a meme coin and then crashing down like an altcoin. Portfolio rebalancing is something that is going to be taking place as well. If bonds, cash yields fall, investors look outward for returns, which can spill into ETFs, listed crypto firms, and then into spot positions for altcoins, including Bitcoin. And let's not forget the narrative feedback loop. The money printer is coming back is a powerful meme that was in both retail and institutional capital. There are people who are on the sidelines waiting for that to happen. So for me, in other videos that I'm going to be sharing with you, I will be outlining what I've been doing to date and how I'm preparing for that. I'm also wiser to the fact that we could also be heading down if nothing changes, but I don't think the status quo will remain. I think liquidity is coming back, driven by central banks. Bitcoin has increasingly been described as a global liquidity barometer. It tends to move early when liquidity inflects. But there are also limiting factors here, guys. If easing happens because growth is falling off a cliff, markets can rotate into safety. You're talking about bonds and gold instead of crypto. That's why we've been seeing gold performing extremely well, doubling in price for both the cards, where it might double from where it was at the beginning of the year, around $3,000 to about $6,000 per ounce. So was the dip just a bull market drawdown? Now, let's try and frame this in scenarios rather than pretending anyone knows the precise path. The first scenario for me would be liquidity supercharges a new leg up. With this thesis, this means the latest drawdown, that flash crash, was just a classic bull market flash. That's my first thesis, trying to explain what happened last month in October. The October flash crash was a positioning and leveraging cleanup. Too much leverage, too fast a run from sub 40K mid-2024 to approximately 120,000 plus during this year, peaking at 126,000. The historic $19 billion or so liquidation event supports that view. Fundamentals still look constructive. Long-term holders remained net profitable versus prior cycles. Spot ETFs, quite near-term outflows, have cemented Bitcoin in mainstream portfolios. In fact, most people who bought Bitcoin as part of their ETFs, majority of them have been holding position. They've not been selling, which means they know what they are doing. They've seen what Bitcoin has done. To them, it's cheaper based on their entry point. Of course, it would have been a lot cheaper getting in there in 2010 or 2011, but for them it's cheaper now because everyone gets the price they deserve. If the Fed pauses quantitative tightening and leans into more cuts and global liquidity continues to turn up, as several analysis suggest, Bitcoin's historical sensitivity suggests it could make new highs with a lag of a few months after liquidity inflects. So we may be seeing Bitcoin's all-time high not in December, maybe not in January, but possibly in February we may see another Bitcoin all-time high. Those who are screaming for 150 to 200K, maybe that may happen then if things play out in our favor. In this world, the recent dip is like the mid-cycle 2013 or 2017 corrections. Brutal, but ultimately a higher low in a broader uptrend. How it could look in practice: BTC holds somewhere above prior cycle highs, say doesn't collapse back below the old 2021 all-time high zone of about $69,000. On-chain metrics like new addresses, transaction fees, stablecoin flows pick back up, and ETF flows turn net positive again. The second scenario here is for Fed liquidity become a dump squib for the crypto markets. And with this thesis, we are talking of cuts won't help much because the problem isn't just rates. This crypto drawdown is driven not only by macro but also by institutional de-risking via ETFs. If big allocators decide they are overweight crypto, they may keep trimming even in a lower rate world. Adoption stalling, that's another factor then. Deutsche Bank research notes retail usage and belief-driven adoption have been slipping, weakening the Tinkerbell-like dependence on belief itself. Regulatory and political pressure, which liquidity alone can't fix. European Central Bank or the ECB research shows that even in aggressive quantitative easing or low risk periods, Bitcoin did not act as a safe haven and was perfectly capable of selling off hard when uncertainty spiked. That's the key, uncertainty. But so far, government support or government adoption or regulations, things are looking great. The fundamentals can be stronger. And if the Fed cuts because growth is deteriorating, markets might treat it as a bad cut and it might indicate a recession, that a recession is coming. So instead of being a green light to aid back into outs, it might actually be a red flag for people to cut down. In this world, liquidity helps a bit, but the structural bear forces, you're talking of regulations, adoption fatigue, ETF outflows, they all still dominate. Crypto chops, perhaps grinds down in real terms even as rates fall. That's the second scenario. And the third and last scenario is the boring and likely somewhere in the middle between the other two. Reality is often somewhere in between. Global liquidity turning up and rate cuts provide a tailwind to crypto compared with 2022 and 2023. But the days when quantitative easing alone could 10x Bitcoin may be over. Well, I don't think we'll be seeing a 10x Bitcoin anytime soon. Now, crypto must compete with AI and tech stocks, real yields that may still be positive, and much stricter institutional risk frameworks. All that means that the dip can still be a bull market correction, and the next leg up may be slower, choppier, and more selective. Talking of BTC and quality L1s and some quality altcoin, not everything being lifted by increasing waves. So, me as an investor, how am I going to think about it going forward without pretending this is financial advice, of course? Well, my structured mental model goes as follows. I'll watch for global liquidity, not just Fed deadlines. I will try and track M2 growth, measure central bank balance sheet, their acceleration or deceleration, which has historically led Bitcoin's major moves in the past by a couple of months. I will try and separate panic from trends. Harsh liquidations and ETF outflows can overshoot in both directions, or you could turn around and say whatever happened in October was probably an overreaction from the markets. We know what happened. I think the market makers pulled liquidity because they did not want to be liquidated and be sent out of business. But even then, I think something happened and someone lost everything and they are just not coming out yet. The key question after the dust settles, do new buyers show up as liquidity improves? And my focus will be on where liquidity concentration is going to be inside crypto. In 2020, 2021, it went everywhere. In the current environment, we are most likely going to see winner takes most, flows into BTC, maybe Ethereum, but most likely Solana will get something there, and some quality layer ones and some perpetual protocols, your hyperliquid, and this won't be a generalized altcoin season. That's what I think, and I'll try and show that I'm trying to play this strategically, and I'm already trying to put together some bear market. I think I've got a portfolio coming up that I called the Crypto Crash portfolio, just to indicate that, yep, even when things are going down this bad, there are still opportunities, and if things turn up or things turn around, I may be able to prove my point. So think of the global liquidity as the tide and crypto as a fleet of increasingly over-engineered safe. When central banks drain liquidity, even the best boards get stranded on sand. When they turn the taps back on, the water usually returns, but whether you glide gracefully or faceplant depends less on the existence of waves and more on your balance, timing, choice of board. The Fed may indeed be about to refill the ocean. Whether this latest dip was the last wipeout before a glorious set of waves or just the first sign of stormy weather, that all depends on something no central bank can predict, and that is sustained belief. Guys, let us know your thoughts about the upcoming liquidity event from central banks and the much trumpeted Federal Reserve of the US's halting of quantitative tightening and possibly starting quantitative easing. Let us know in the comment section, guys. Until the next one, FD for 65.tv. Signing out for now. Bye.